Jeremy, why 50 basis points immediately?
Well, yesterday morning, we had the Fed funds rate 50 basis points above the 10-year Treasury. That is crazy. That inversion is very steep. You know, it should be 50 basis points below the 10-year Treasury. Fed funds rate now is the highest administered rate in the developed world of any maturity. Secondly, I don't think the economy is all that strong, and that's before these trade disturbances. Recent data looks like second quarter, instead of being 2.1%, is going to be under 2. Experts say this quarter looks under 2%. I didn't think that employment report that we had last Friday was really all that strong. Hours worked, etc. I'm not talking about recession. I don't see a recession. I see a meaningful slowdown. And probably, I think, another good reason why the Fed should move, if the Fed moved down 50 basis points, Trump would have no one to blame for an economic slowdown except his trade policy. He couldn't pin the blame on Jay Powell. It takes that out of the equation. So, in a way, it will put pressure on him. Got to make a deal with China. It may not be his ideal deal, but the market wants a deal, and I think he has to move forward on that.
Well, that's a big assumption in terms of the president and who he would blame or not. I mean, we got 25 basis points a week ago, Jeremy, and he's tweeted almost every day attacking the Fed, including this morning, saying, of course, and linking it to the stronger than what he would like to see dollar. You know.
Yeah, well, you know, I mean, I thought that they should go down 50. Now, I was on CNBC and said they're only going to go down 25, but I thought actually the term structure, other rates, and this is before these trade disturbances. Don't forget. I mean, capital spending was already weak in the second quarter. This added uncertainty is not going to do anything for the economy. I mean, we really may, if this trade disturbances continue, we may have a third quarter in the low 1%, which I think is too much of a slowdown.
Yeah, I do wonder, though, I mean, the impact of even further lowering rates. I mean, look at Europe right now. Look at the world, 15 trillion in sovereign debt that's negative. It doesn't seem to be helping their economies too much.
Yeah, I mean, but no, don't forget, I'm not talking about moving down to zero. I'm talking about maybe moving into the, into the 1.5 range, which really approximates what our GDP growth is right there. I mean, you know, Europe is like between 0 and 1 with a lot more labor problems and other problems that are facing them. Also, you know, we have this report out of PIMCO, something I've been saying for a long time. You know, there's a lot of demographic factors that are influencing these interest rates. The aging of the population is one of those factors, and it is really advanced in Japan and in Europe more than the United States. That is a big factor that more and more economists believe is one of the long-term factors that are pushing interest rates lower. So that's another reason why Europe has lower interest rates than the United States, and Japan was first to get there, 10, 15 years ago. So, these are even beyond central bank situations. The central bank should not fight it by trying to get interest rates back up to where they were in the 90s or 2000. We live in a very, very different world today than we did back then.
Professor, I wonder why you think that the administration needs to get a trade deal by 2020. We have a number of folks who come on and say that they believe that, the administration needs to make that happen before the election next year. I'm not so convinced. And I think part of the reason is because we're sitting at this point in time. It's a point in time in history that books are going to be written about and that folks in the future are going to look at and say, this is an example of what not to do with policy. Or if we do get a historical trade deal, or a historic trade deal, that this is what to do with policy. And I just can't help but think that that's really what the president is gunning for right now, rather than making sure markets continue to move towards record highs.
Well, my feeling is that the only chance Trump has for re-election is a good economy and a good stock market. I mean, in all the polls given, it's the only thing he has had net positive results on. So if he wants to be real, and he says, I'm going to give up re-election and go for this, that's one thing. I don't think that's in his equation. And look what happened with the NAFTA. I mean, really, this U.S.-Mexican trade deal isn't all that much different. Certainly, it's not a revolutionary new trade deal. He went with that. I think, he's going to get the best thing he can, but in the end, I think he's going to make a deal with the Chinese to get the economy back on track by the summer of 2020. I think that's his that's his only re-election strategy that I think will work for him.
All right. Finally, Professor, what does all this do to your outlook in terms of the stock market for the remainder of the year?
Yeah, it is. I mean, first of all, I do think estimates fourth quarter are too high and 2020 are too high. Of course, it's always too high. We always sort of bring them down. But with GDP in the 1% range, I mean, people have, 8, 10, 12% estimates on 2020 going forward. I don't see how that happens. A muted stock market. Listen, if we get that trade deal, I said we'd be up 5% ago, so we'd be up 10, 12% maybe from where we are today. A continued trade war that steepens there, I don't see a higher stock market by year's end.